I know.
So I'm going to introduce this guy. On his boat, you can call him captain, but as your lawyer, he will sink Admiral Insurance and any other adversary insurance company that sails into his client's waters. An Anderson Kill equity shareholder and my esteemed co-chair of the Anderson Kill Construction Group, Dennis Arteezy.
Wow, what an intro. Thank you, Alan. Why don't I turn it over to my co-presenters to briefly introduce themselves, and then we'll get moving. Chris?
Hi, everyone. I'm a managing director with Berkeley Research Group, BRG, and I focus on preparing claims. I'm a forensic accountant, and I prepare different types of claims. Builder's risk is just one of them. Cyber claims, standard business interruption claims for an explosion or a fire at a plant, product recall, really all different types of claims. But one of my specialties is builder risk claims, so we'll get into that.
Great. And Jaron?
I'm Jaren. I'm an associate director at BRG, work with Chris. I am in the construction industry and I focus on the builder's risk, ongoing construction, and I don't have a boat.
I have to remedy that. At least get you an invite on one. I can handle that. Okay. Thanks, guys. And thanks again, everyone, for attending. Our focus here today is on builder's risk. Right. So we'll cover a few different things. We're going to talk about generally what builder's risk covers. It'll be somewhat of a primer. I don't know. How many of you are intimately familiar with builder's risk? Oh, good. And how many of you have some familiarity with builder's risk? Okay, good. So it seems like we've got some experts and we've got some people that can learn a few things. So any way we can make this a lively discussion, let's try to do that. We'll take questions as they come along. We're happy to do that, make this more of a conversation rather than just listening us, go on and on. But we'll talk about generally what it covers. We'll spend a fair amount of time on construction delay. That's a really important part of builder's risk, and we've got some really great experts in that area up here today. And we'll talk about some common areas of dispute. So first, as a quick primer for those in the audience who may not be as familiar with builder's risk, just think of it as property insurance for construction projects, right? That's the easiest way to think about it. We're not talking about liability coverage here where there's a claim or bodily injury. We're talking about property damage at a construction project. You have, resulting from that, you're going to have your hard costs, and you're going to have soft costs, and you're going to have time element, right? It's typically purchased by the owner. It also protects the general contractor in most instances. As far as best practice, it's really important that you specifically name whoever you want to cover in that policy because there are disputes that arise as a result of that issue. And what is the purpose of builder's risk? It's basically to put the owner and the general contractor back into the position that they were in before the loss occurred. So whatever it is you're building a hospital, you're building a power plant, you're 80% through construction, and you have an insured accident on the site, right? Maybe it's a fire, maybe it's a water damage loss, maybe it's an explosion. That's going to set you back. You're now going to have to incur a lot of cost to get you back up to that 80%. Those are supposed to be covered. Those are your hard costs. And you're also going to have schedule slippage, right? You're going to have delays. Your hospital that was supposed to open on January 1st and create a profit for you is now going to be delayed because you had this insured accident. So what are those profits? What is that delay period? And what are those profits you would have had during that period? That's what it's designed to cover. So most of these policies are written on an all risk basis. That's basically, we will pay all risk of physical loss or damage except as excluded. That's the broadest form of coverage in property insurance and no different in builder's risk. So all causes of loss will be covered unless they're specifically excluded. You're going to, most likely, you will have replacement cost value, right? You want to get your project back to where it was. You're going to need that replacement cost value coverage. And they'll also include typically reasonable overhead and profit. Another important aspect of the coverage, right? It'll usually say something like, we'll cover reasonable overhead and profit, not to exceed the value set forth in the contract. Right? So your owner has a contract with a GC, maybe it calls for 7% overhead and profit, maybe it's 10, maybe it's 20, whatever it is. There will often be fights about what is reasonable overhead and profit, and that is something that can be debated. More often than not, it could be worked out. I actually had a case where a very large builder's risk loss for a power plant explosion in Connecticut, where the policy specifically said that it included contractor overhead and profit, and yet they wanted to pay zero on it. There is no real reason basis. They just said it's zero. So it required a lawsuit and a summary judgment motion before they had to come to Jesus and pay the claim. Sometimes you get that. In terms of what's covered in terms of hard costs, you're going to look at your materials and equipment. Typically, it's required that they be intended to become a permanent part of the project. So nothing transient, nothing mobile, nothing that's not going to become a part of the project. And then there's also expediting an extra expense, which we'll get into a little bit more. And then you're going to have your time element coverages, right? This is your lost profits portion of this, but also there are other soft costs. You're going to have some continuing costs during the project that are going to be increased because your project is increased. The duration of your project is increased. You're paying interest on your construction loans. That doesn't go away because you had a loss. You're going to have to continue to pay that. That increased interest expense could be a covered soft cost. And then you're going to have, that's just by way of example. Then you're going to have your delay in opening, depending on your type of project. Is it something that you're going to be renting after you completed it? You look to your rental value coverage. All other types of income generating projects, you look to your general business interruption coverage. And there's a way to calculate that period of delay, which we will let the experts talk about because I've probably gone too long on this one slide already.
Yeah, just fundamentally, let me point out as well that there is clearly a very similar to your standard business interruption and property damage claim. But one really important fundamental difference is, of course, in a builder's risk claim, you don't have a property that's already been in use for years. So for example, if you're a hospital, in Dennis's example, the hospital has 5 years of history, and you can look at what they're doing and all that stuff. And from my perspective, preparing a claim for a hospital, for example, that has never opened, is you need to rely, and it's a little more tricky because you don't have the history to go back to. And then fundamentally as well, a big important difference for a builder's risk claim is you almost always need someone like Jaron, because the time period is subjective. You know, immediately the insurance company is going to challenge, when would you have opened if this incident didn't occur? On the other hand, if you had, just use the example of a hospital, that you don't have to worry about when the time period, it's not as difficult because the repairs are what they are effectively. So there's a big difference between the two.
Yeah, and one other thing I should mention, the time element coverages aren't always covered. They aren't always automatically covered. They have to be purchased. There's, separate check boxes and typically additional premiums associated with soft cost coverage and delay in opening. And unless that coverage is actually purchased, don't expect to see it. Karen?
Thank you for setting me up there, both of you. As Dennis mentioned, the hard cost, the property damage, the cost it takes both to demo and then to rebuild up to and exactly what was lost. Those soft costs, it gets hairy, as everything does when it comes to an insurance claim. These tend to include not only owner costs, but GC's overhead. And that's where the big fights come out, because the general contractor will say, I'm not a soft cost, and you're not, except when it comes to insurers, when they say, well, no, your staff, your project management, that's all overhead, that's a soft cost, and that's where this falls. And then the delay in opening is purely driven by the project schedule and the number of days lost. Hard costs, we've now covered that one 3 times, but something to note is that in addition to the hard cost recovering supplements, the policy will typically have other things that are hard cost adjacent. There'll be a supplement for temp storage generally. If you can't accept deliveries because your project site is on hold, stop work order, you're not ready at a place to accept permanent material, there should be some coverage for what it takes to rent somewhere to keep your elevators, for example. There's going to be professional fees available if you need to work with the designer to come up with a fix for whatever happened, and other things that are sort of hard, are sort of soft. There are generally other sublimits, and they're usually focused in hard that aren't necessarily property damage.
Another thing I would say briefly on the hard costs is that, once again, if you're in construction, you're working on obviously the construction to complete the project. And now an incident occurs and you got to work on the repairs. So you've got those two going on parallel. So got to be very careful to split out those two, because obviously only the piece that is pertains to the repairs would be claimable. The rest of it is just to complete the project. So it gets tricky.
As always, when it comes to construction, the ones with the best documentation wins across the board. That's invoices, that's pictures, that's daily reports and more daily reports. It's project schedule narratives, pay applications, change orders. The more documents that there are to show where you were before the loss and what you've spent to get back to it, the more easily and smoothly the insurance claim process will go. One other thing that we typically see that throws people for a loop is the idea of a betterment. I have a project that had a flood. The inside courtyard, it was a residential property, the inside courtyard basically turned into a bathtub. And they drilled holes to let the water go down, and it went into the garage and they were able to pump it out. And they designed a system for the next flood because it rains all the time here now. And that betterment, the new drainage system to capture intense rains so that way it doesn't become a flood zone again and they don't damage the first floor drywall, et cetera, is a betterment. And the insurers wouldn't cover those costs even though it was to prevent another loss occurring. So the general contractor I was working with had to put together an estimate for what it would have cost to repair it after they did the hole drilling to get the water to come out with the pumps, et cetera. And it was just a whole thing, a whole conversation, when instead of being able to pay for what they really did, it didn't count.
In it as an alternative repair,
Alternative repair.
really, instead of a betterment for the insurance companies.
There were spins involved.
In a way.
Yeah, there are always some limitations to spins. I mean, a lot of times in this types of coverage, you're dealing in the hypothetical, right? You have to say, okay, we didn't build it back exactly like that, but if we had built it back exactly as was, this is what it would have cost. Or, we obviously are projecting our, delay in opening losses. No, we didn't open before. We don't have actual data to show you this was the trend over the last 3 years, but we can reasonably approximate and project that this would have been our business experience had we been able to open at the time. So, in insurance claims, and it's particularly in property insurance claims, we're often dealing in the hypothetical. Talk about soft costs?
Yeah, the soft costs, just generally speaking, most policies will cover the additional soft costs. So if you delayed, let's say 6 months, right? And to Jaren's point, Jaren might say 6 months, the insurance company will bring in the JS Helds of the world that might say 4 months. And that's of course where she needs to iron it out, hopefully get 7 months. But in the meantime, the soft cost for that time period should be covered, right? But one thing that we see in these cases is that if a soft cost is not listed, insurance company might say, hey, it's just not listed. So I would highly recommend you be careful in your policy to make sure all soft costs are listed. Okay. I'd just make sure that all your soft costs are listed, because I've had cases like that where the insurance company says, hey, I know you have additional soft costs, but the policy specifically doesn't list that soft cost. So that's that. But we'll get to it in a minute. But one of the biggest things with soft costs is the overlap of the delay in opening, because the insurance company will say that if we pay you for your lost business interruption or your loss of rents, then why do we also have to pay your additional soft costs? Because essentially we're making you whole with respect to your business interruption. And therefore, if you have additional, interest and things like that, then it's picked up by your loss of rents. But I will get to that in a moment.
Okay.
All right,
Chris?
so, yep, so this is your typical wording under a policy. Most of them are similar to this. And sometimes they would say your lost sales less your discontinuing cost. This one says net income plus your continuing cost, which should get you to the same thing. We've gone through that many times, but it should get you to the same thing. But that's fundamentally what would have happened if the incident didn't occur. What would you have made for profit? And then what were your continuing costs that you couldn't save after the incident occurred?
Yeah, as Chris points out, there's a few different methodologies to calculate loss of business income. I think it's important that you do follow the one in the policy, even though other methodologies will get you to the same place. It's one less argument you don't want to have to deal with the insurance company. They'll say, well, you didn't calculate it exactly as required under the policy. Well, maybe not, but the concepts are exactly the same and the result is exactly the same. But do you really want to have to deal with that argument from the court, right? So when you're preparing these losses, always consult the policy language and do it specifically as required in the policy.
Okay, so most builders' risk policies, once again, it's important, and I'm sure Dennis would say, to review your policies, see specifically what your policy provides. But most of them would have coverage for your contractual penalties. So if you have to pay a penalty because you're late or what have you, that's typically picked up under the policy. And then extra expenses, for example, temporary facilities that you set up to mitigate the loss and, get back in business. Those would typically be covered under just about all builders risk policies.
Yeah, sorry, go ahead.
Another place where general contractors can recoup some of their damages are extra expense. If a general contractor has brought in another body to manage this work, as Chris said, you're dealing with the loss and hopefully you're still carrying on with your regular construction work. If you bring on another person, again, as long as you have documentation, whether it was an org chart or a staffing plan or be it, you can show that you brought in another person or a few people to manage that extra work. Those people can be covered sometimes under extra expense rather than your soft costs or your general conditions, which helps ease what will undoubtedly be a pinch on the supplement.
Yeah, speaking of sublimits, when it comes to coverage for contractual penalties like, liquidated delay damages, for example, we always see that in the context of delay claims, right? Sometimes these policies will say, we will pay for contractual penalties for liquidated damages, but only in excess of amounts you recover from your general contractor. And then subject to a cap, subject to a sublimit. So as with all of these provisions, you have to read it very closely in the policy and see exactly what it's going to cover and what it won't.
So most policies would have either business income coverage or rental value. I've seen it where they have both. But effectively, if it's a hospital, for example, you don't have rental value coverage. If it's an apartment, it's typically based on the rental value. It really gets you back to the same point. What did you lose in sales as a result of the delay? Less what did you save?
And these are just some examples of the wording you'll see.
How do we measure the construction delay? As I mentioned earlier, whoever has the best documentation wins. And I hate to use the word wins, but it's wins, right? You need to know when the project was expected to complete before the loss event, when the project completed after the loss event. Somehow those things are very subjective. We have a pre-loss schedule, and then how do we calculate the delay? There's countless methods. And I was convinced to take out all of the graphics I had about the 7 different methods that I have used. It was a good feedback. I appreciate that. But the number of days can be contentious and can be subjective, unfortunately. And there's a handful of different methodologies that most typically are acceptable to insurers. And so when I am brought in, when there's a loss, I, as soon as I can, try to get the pre-loss schedule. And when you have a accurate, adequate project schedule that is ongoing, right? It comes out every month and it's accepted and everyone agrees that's your starting point. That's a really good start to your construction delay. What comes next depends on the loss. It always depends, right? If you have something that is almost a total loss, that's going to take you a little while to figure out what you're going to be able to do to get back on track. If you can keep working in other places, but you stopped in one spot, how far off the critical path was that one spot, right? It's really project and incident dependent. And so that's where you need a construction expert to come in and do your critical path analysis. If you have something that is not critical path and it is delayed and then you fix it and you haven't lost any days, you can't recoup time. If you have internal project milestones that contractually were obligated to be hit and you miss one, it's unlikely that you will get delay under the insurance policy if your final end date hasn't slipped. It really depends on the wording of how it's put in the policy.
The other thing I would say on that is most policies would allow you to just recover the delay. So if, again, Jaren says you would have opened on December 31st, you opened on June 30th, that's a, say, a 6-month delay. As we said, she'd have a debate with the other side who would say it's only a 3-month delay. But it's also, once again, important to look at your policy, because some policies, they literally have had cases where the adjuster kind of wants to disregard what the engineers are saying and say, well, your policy states that you were planning to open on a particular date, and the specific wording in the policy says that you should use that date. So it's illogical, frankly, right? Because if you were going to open up on, in my example, December 31st, but the policy says, whatever, January 31st, then it doesn't make sense, right? It should be really what your true delay is. And what I'm always concerned with is the insurance companies like to get the best of both worlds. So if it's worse, they'll play that card. If it's better, they won't. And so but again, to me, it's important to look at your policy ahead of time, because essentially all you want to recover, generally speaking, is your damn delay. You're not looking to recover more, and you certainly aren't going to accept less.
I have a current project right now where they're actually tracking ahead of their insurance policy, ahead of schedule, but didn't tell the insurer and didn't change the policy to pull it forward. Had a delay, lost 4 months, and immediately off the bat, the difference between their planned substantial completion date and the policy anticipated completion date is just thrown away.
And of course, it goes without saying that it could be a multi-million-dollar issue. I've seen it in many cases where, they kind of know, again, the logic that both of us are saying, but they still want to, play the card and say it's not what the policy says.
Yeah, a lot of policies will try to account for that and say, here's the project anticipated completion date based on the schedule, pre-construction schedule, or any later schedules that are later provided to us, right? So there's a modification mechanism in some of these policies, but if you don't provide the schedule, then there's all sorts of problems that arise around that. So projects, they take longer than expected, more often than not. Rarely, they
Almost always.
almost always.
Always.
In the rare instance where, they managed to expedite this project and they're going to complete it earlier.
It was expedited after an extension. So.
Okay. So there was some slippage at least, and then they managed to catch up. But the takeaway is constantly update your insurance company, keep them apprised of what the new projected completion dates are. When a claim does happen, the insurance companies will drown you in RFIs, right? Requests for information. They'll want all the daily schedules. They want the meeting minutes. They want everything. And they're going to want to see every schedule. They're going to want to see it in, Primavera and Native. They're going to, in every format that it possibly exists. And as Jaren has said, the more the documentation, the better, right? You want to be able to document your losses and your slippage. And the only way to causation is a big factor, right? You want to be able to show that your delay was caused by the covered incident. A lot of things happen during the construction. Subcontractor just might not show up, right? That's not a covered delay under the builder's risk policy. You may have a weather event, may or may not be covered under the policy. You want to be able to show that your schedule slippage all related to the covered incident. So the more documentation you have, the far better off you'll be.
Real quickly, Dennis, on that point, we see this also in your standard first-party matters where, for example, you might have windstorm coverage, but not flood coverage. But the windstorm comes in and it causes a flood. Now, is storm surge covered under windstorm or is it covered under flood? So it's, again, it's tricky and important to look at it.
Yeah, and many of you may be more familiar with a period of restoration under general property insurance policy, which is calculated very differently. There, you're going to start the period on the day of the loss. Here, under builder's risk, we don't start at the date of the loss. So going back to general property, you start at the day of the loss, you finish on the date that it would take with reasonable due diligence and dispatch to complete the repairs, right? It's somewhat of an easier period to calculate, but still a hypothetical. With builder's risk losses, you're not starting at the date of loss. You're starting at the date that you thought you would finish the project. And then you're ending in the date where you actually finish the project, again, with due diligence and dispatch. And they're going to be looking for concurrent delays throughout that entire period. Well, you would have been 4 months behind anyway because of all these other things that happen. Well, during your rebuild, you were able to, recoup some losses. You did some expediting. You picked up schedule. You ran the project faster than you thought. So your delay is actually, shorter than you thought. So there's all sorts of issues there, but I just wanted to make clear that it's not the same analysis, and some policyholders get a little confused by that.
I think we have a point on concurrency in
Okay.
a later slide, but I will give an example. I have a project that had a freeze issue, a pipe burst. They were a month away from their first TCO inspections, $14 million worth of property damage. The insurer paid out the property damage and found 0 days of delay because other things were going on and you would have been delayed anyways. And there was no reasoning with them about $14 million worth of damage absolutely delayed
Yeah.
their critical path. That one went to litigation. I couldn't stop that one. So
That makes sense. That's like my insurance company who just wouldn't pay for overhead and profit, even though the policy said we pay for overhead and profit.
you can
Keep going.
yeah. So these are the maybe top 5 schedule analysis methodologies. Again, it depends on what information you have and where you are in the project and in the rebuild. I have had some successful negotiations with impacted as planned, where you model. This is especially useful at the beginning of a project where you're maybe 25% of the way in and the loss comes. You don't want to wait until the end of the project, which could be a 2 or 3 year thing, to hash this out with the insurers. And you don't want to wait to get paid till then. And so in that instance, you model your delay, how long it takes to demo, how long it takes to rebuild, and you insert that into the schedule and you compare your planned schedule date with your next planned schedule date. I have had some success with that. If it's closer to the end of the project, we'll do a time impact analysis or a windows analysis or an as-built analysis, which really just compare real information. When did you actually finish? And those instances, they can be successful as well, depending on how good the project schedule information is and how clear it is. This is a visual, the one that I was allowed to keep in. The green is your plan. Your incident happened. We don't show where on the green plan your incident happened, but probably it was activity number 3 that's taken 3 times as long. And then your activity 4 continues, and you can see where you plan to finish at the end of the 4 bar in green, where you actually finished at the end of the blue bar there. That's your project delay. And that's what Dennis was talking about, where your delay is not from the date of loss. Your delay is when did you think you would be done to when you actually finished, and that number of days.
We don't want to complicate it too much, but keep in mind as well that you could have, for example, 2 towers. One tower is damaged, the other tower opens on time. And so part of the project opens on time. So it makes it extremely complicated, right?
In those instances, where you have two towers, or in New York City commonly multiple TCOs, if there are TCOs or towers or buildings or parts of buildings that didn't get damaged, there's a really big expectation that you build those on time. And there's almost no accounting for, unless there was a stop work order, there's no accounting for side delays, right? Nothing like, oh, my project manager had to split their focus, or the teams were split, or if you have a portion that could be completed and that's separate, you're very much expected to keep building that. Any delays to that building are poo-pooed upon.
Which is not reality. We all know, right? If you have a major catastrophic loss to one part of your project, everything is slowing down. That's the reality. And so oftentimes you have to push back in those scenarios.
This chart is a fundamental thing we see on all builders risk claims. And in some cases, it's not an issue with the other side, the insurer, but in many cases it is. For example, if you have an apartment building that you plan to open on December 31st, you're obviously not going to open up at 95% occupancy, of course, right? So you're going to go through a ramp up period. So if you plan to open up at 40%, 50%, 70% to get to the 95% level 6 months down the road, you obviously will still need to do that, right? You're not, just because you're delayed doesn't mean you now will be able to open up at 95%. But I've had cases where the insurance company's accountants try to come in and say, well, your loss should be based in the first month on, in my example, 40%. So 40% of the revenue of the occupancy, let's say is only $1 million, but 95% is, whatever it is, $3 million. So the point is we always make the argument, and usually successfully so, that the loss is at the mature state. So once again, if you're an apartment building, you still have to go through that ramp up period. You ultimately will lose 6 months at 95%. Now, it gets even more complicated because in some cases, a forensic accountant will often say, let's look at what happens when you do open, right? So for example, if you have, once again, an apartment building, and let's say on the rates you expect to, Dennis and I just had a matter like this, as a matter of fact, where the opposing attorney was trying to make the point that if you have an incident and your rates on the, let's say the one tower that wasn't damaged are low, then shouldn't that be the rates that you use in preparing your damages? So in other words, if you're projected to rent on an apartment at $3,000 a month, but you open up and you're only doing it $2,800 a month, the insurance company might say, no, we think it should be based on the $2,800 a month. But what they fail to understand is you had a damaged property.
Yeah.
You literally just had.
And no, people don't love moving in when the building across the street or the units across the hall are under construction. So you're going to get lower rates. There's going to be concessions.
Yeah, there's a doctrine at play here known as the wider effects doctrine, where both sides try to use this to their benefit. Whether or not you could take into account the wider effects of a catastrophic event. You have a hurricane come through, right? Take Katrina, take anyone, for example. Resources are spread pretty thinly. Labor costs go up, material costs go up. And you go, well, okay, well, you have to factor that into the loss, obviously. Conversely, the insurance company might say, well, you hypothetically, you're the only entity operating. You're a rental property. You could have housed all these workers and everyone else. Hypothetically, you could have charged an arm and a leg because of supply and demand. So now we have to account for that. And the courts overwhelmingly reject those arguments on both sides. The only law agreeing to apply wider effects is always policyholder friendly, right? So the only cases that exist out there, the last time I looked, were all policyholder, pro-policyholder decisions that said the policyholder can take into account some of the wider effects of the storm, but the insurance company cannot use them to minimize the loss.
Yeah. Briefly, I just had a deposition on this point. Once again, essentially, if you have two towers, the attorney was dogmatic, and she thought she was correct to say, well, Mr. Brophy, isn't it true that if one tower is impacted, that your supply is down? And wouldn't it simply be supply and demand, that if one tower is down, the demand in the other tower would be up, which is true. I had to acknowledge that's true. But you need to balance the fact that the supply and demand might be one thing, but the other tower isn't going to be occupied as much if the first tower is significantly damaged.
Yeah.
So it's interesting.
It's yeah, it's the quality of the experience, right? If you have a hotel, you know, how many of you want a vacation in a tower next to one that's under construction?
Right.
You know, none of us probably, if we have a choice to go to another island, we'll just do that. So it's not, you know, the demand question, I think, remains. How much of a demand is there really for a premises that's under construction?
So essentially, there's three areas we would say of disputes. One is quantum, one is construction, and third, we'll get to in a second, is coverage. Quantum is more me, Jaren is more construction dispute, and coverage would be more Dennis, of course. Uh, Quantum dispute, we talked about a lot of those. Once again, one of the biggest things in a builder's risk claim is without the history, it's just simply more subjective, right? Once again, you have a apartment building, as I said, that you're going to open, you think you're going to open it up at, you know, X percentage, you think you're going to have a certain rate for that apartment building. Who knows, quite frankly, it's just simply more subjective. On the other hand, if you have an apartment building that's been operating for 10 years and it has projections and all, it's just easier, I guess is the biggest point there. And then the second one we talked about, the incident impact operations after reopening. Once again, the insurance company, in my view, will try to, you know, take both sides of it. If the rates, as I said before, are down when you reopen, they'll try to say, well, that's the rates you would have had when you were closed. And then the soft costs, we talked about this earlier. This gets a little complicated, but there is an argument that if you're reimbursed for your lost revenue, that you're not entitled to the additional soft cost. So we would look at that, you know, specifically. But for example, let's say you have a construction loan and you intend the loan to go just through the construction period, and now the construction period is pushed out by 6 months, you clearly have higher interest rates, interest, even though you still will have the revenue.
Yeah.
Because the construction loan is now 10 and a half years instead of 10 years.
Yeah, I would ask why we paid a separate premium for soft costs on top of the business income if you weren't going to pay for both. Right?
Sure, yeah.
Yeah. And talk about construction disputes.
Common areas of dispute, dollars and days lead to dollars. Again, this is a big one of, do you have your paperwork in order for what are the costs to repair? There's always going to be questions about, did you get 3 quotes to compare? Is the contractor who you had there already giving you the best price for the repair? And it's really, really frustrating when one of your subcontractors whose work has been damaged gives you a price to repair their work and the insurer says, oh, that's too much money. Oh, okay. You know, it's then you have to further the conversation, and it really just makes for an inefficient perspective. And so in that regard, when you're gathering pricing for repair, for demo, having as detailed proposals as possible really helps make the process go as smooth as it can. And then about the time to complete repairs, again, having the right schedule documentation, having clear and clean schedules, and doing your best to minimize the concurrent delays so that there's no easy thing for an insurer to point to and say, that would have delayed you anyways. I've had them say, well, these RFIs were dated after the loss event. Those RFIs would have gone in then anyways. You would have been delayed. You wouldn't have been able to finish without those RFIs. And you try to respond reasonably saying, well, that's the way the construction went. And when they got to that point, they realized they had a question in the drawings, right? But it's always back and forth. And again, the best documentation generally will be awarded the most amount of days.
So in terms of coverage disputes, you know, one area that's more frequently litigated now in the insurance industry seems to really be pressing it in builders risk claims is the exclusion for faulty workmanship, defective design. Sometimes these are referred to as the leg 1, 2, and 3 exclusions. LEG stands for the London Engineering Group. They're basically the service that puts together these form exclusions for some of the insurance industry. And they've come out with 3 different versions of this faulty workmanship exclusion. You know, basically what it says that it's, you know, it's hard is that they're not going to pay for loss or damage caused by or resulting from defective design, plans, specification, materials, or workmanship in the construction projects. And starting with leg 1, that is the most restrictive exclusion. It's basically a full exclusion that will exclude anything that arises out of a faulty workmanship or design. Then they sell another version called leg 2. This is more of a middle ground where they say, okay, you have a defective design or workmanship that causes some damage. We're not going to pay for any repairs to the defect itself, but we will pay to repair any resulting damage to other parts of the project other than the defective work. And then you've got the leg 3 exclusion, which is the broadest coverage. That's going to cover both the cost to repair the original defect. Great. It's going to pay the repairs for the resulting damage, right? Any damage that is to other parts of the work. The only thing it's going to exclude are any costs to improve the original work or the original design. And even that has been contested. First of all, courts have recognized that this is basically a substantial coverage enhancement. Even though it's styled as an exclusion, what it basically does is, takes away the typical faulty work exclusion and enhances the coverage by providing this very broad coverage, even to the defect itself. So it's basically a recognition that construction defect is covered in the first party context. It's often covered in third party as well, but I don't want to go down that rabbit hole just yet. But this exclusion, so the only thing that's not going to be covered is your cost to improve. And even that has been successfully challenged. Well, what does it mean to improve an original defect? You could see it argued both ways. And there's one, sort of landmark case involving a bridge, a concrete bridge, where they were pouring the concrete and they didn't vibrate the concrete or they didn't vibrate it correctly. And it caused this honeycombing, which caused all sorts of structural problems with the bridge. Next thing you know, the bridge basically has to be taken down and rebuilt. This is a leg 3 endorsement or leg 3 exclusion. You get the cost to repair that defect. Even if all the damage is to the defect itself, you get that cost. So no question you get that. The insurance company said, hold on, by correcting that defect, you are in essence improving it. And the court said, well, sure. I mean, you can say that any correction of a problem could be considered an improvement, but that would completely swallow the exception, right? That would render it illusory, essentially. So, and in the same token, they said, well, if the contractor said, okay, well, I had concrete there, and now I'm going to replace my concrete with solid gold, now that's an improvement, and that's excluded. But essentially, what they said, the court said, it was this exclusion was hopelessly ambiguous. They actually used some really strong language that I got a chuckle at. They described the provision as tortured and egregiously ambiguous. They classified it as internally inconsistent, bordering on incomprehensible, and noted calling the language convoluted is an understatement. I mean, they really, really went after the drafter of this, which is great but it's a huge win for policyholders and really important decision. If you don't already know, ambiguity is like a policyholder's best friend. Normally, these policies are drafted by the insurance company, and there's a doctrine in the law called contra pro forentum. It says if the provision that you're arguing about is reasonably susceptible to more than one reasonable meaning, then we're going to construe it against the insurance company as the drafter. So, this is a really, hopefully if you have to have a construction defect exclusion in your policy, and they basically all do, you want a leg 3 exclusion. I think there is somewhat of a trend here in narrowly interpreting these types of exclusions. One way or another, a court will try to distinguish between the resulting damage, because they almost all have what we call these ensuing loss provisions we'll talk about in a minute, differentiating between the cost to repair the original defect and cost to repair damage that was caused by that defect, right? Damage to other parts of the project. And again, as I mentioned, there's law saying that this is a coverage enhancing endorsement. So ensuing loss doctrine, right? So you're going to have these exclusions, and they're going to say, we don't pay for your cost resulting from, or any loss resulting from defective work or planning. And then they'll have but, right? But, you know, any ensuing loss to covered property that's not excluded by any other provision in the policy is covered. There's a few different ways they say it. They might say if loss or damage by a covered cause of loss results, the insurer will pay for loss or damage caused by the covered cause of loss. So what we're talking about here is a defect happens, the defect causes some type of loss. Is there some type of intervening peril that is covered, right? Classic examples, you have a roof that is constructed improperly. Maybe it's designed improperly. Maybe it's constructed improperly. Exterior walls, windows, those are defective. The defect itself is not going to be covered under some of these provisions. But what happens when water comes in and infiltrates the interior of the building or causes damage to other parts of the roof that were not defectively designed? Most courts will say that that resulting damage is an ensuing loss that is covered. And the insurance industry says, hold on, what do you mean? That's a natural consequence. Of course, if you design your roof deficiently or you build your roof deficiently, of course water is going to come in. How could we possibly call that an ensuing loss?